concept of value investing is one that is easy to understand but very hard to implement. Now, one South African recently left our shores and established a private fund with a mandate to seek out global value opportunities. Many of the ideas are finding their way into the portfolio of small cap US stocks that have been enjoying plenty of bad news. Here to discuss this approach, direct from Houston, Rory Mackay, CEO of TSL Capital Managers. Thank you so much for joining us. So Rory, please explain that to us. You left South Africa firstly, and you were a derivative trader, you were a high frequency trader, and now you're moving into a space that is, of course, a lot less active when it comes to trading on a day-to-day basis.
Absolutely. I wanted to move into a field which I could do until I fell into the grave. And so I talk about my job nowadays as a combination of being a detective and a librarian. And it's something that I can do without sitting in front of a screen all day. And I analyze companies and look for good value and purchase it. And I have a 3 to 5 year investment horizon. So that
Sounds like there's a lot more qualitative kind of approach to investing when it comes to value investing. Is that what you're insinuating there?
Not really. I use quantitative methods to determine which are probable investments, and then I use qualitative methods to determine.
To back them up.
Exactly.
Mm-hmm.
So Rory, just in terms of the approach, I mean, we have a small market here in relation to something the size of the US market. The screening must be an important part of the process. What are the types of things you're looking for specifically for this portfolio in terms of ideas?
Well, the first thing I look for are good stocks cheap. And I define a good stock as a stock that's got a high return on capital and a cheap stock that's got a low PE. So I set up parameters and search through the 5,000 odd stocks that are available for investing in the US, and then divide it into deciles, and say I'm left with about 500 at the end. And then sort through them on using other parameters, so whether they have too much debt and what their current ratios, how their balance sheets look, what their management are like. And then from that, I probably get down to about 50 stocks, and out of those, then I choose. Usually I choose what I like to term as simple businesses that I can understand and that I have some confidence of projecting their earnings a few years ahead into the future.
Okay, now this has been quite interesting because it's a global value, it seeks out global value opportunities, but you've been concentrating most of your time on US equities, specifically some of the small cap stocks. Just to touch on other areas of the world, we mentioned before we came on air, we talked about Europe and Japan. Surely Europe must be a bargain basement sale going at this point in time. Why are you not looking at Europe in particular?
I'm still very nervous of Europe. I don't think the cookies crumbled there. So I still think that the market is being supported by all the cheap money that's flowing in. And I don't think the market is not totally taking cognizance of what's going to happen in Europe.
So there's a lot of uncertainty around how things are still going to progress there. Yeah. And even with stocks at very cheap levels, it's not really making it that attractive yet without seeing a sort of bigger solution at the macro level.
Absolutely.
So when it comes to your investable universe right now, I mean, what stocks or what geographies are you looking at?
Pretty much, I'm looking at the US. I think I have confidence that the US is an economy which has the propensity to recover the quickest. And that guides my investment decisions. I'm not generally a macro person. I try to invest from the bottom up. So at this point in time, I'm happy to focus on the US.
And of course, you talk about the good stock, and then of course it needs to be cheap from a value investing perspective. Speaking to Clem Santa, of course, we all know here in South Africa, futurist. He looks at various scenarios, and he says, you have to be a dog whisperer, and a dog whisperer is one that is able to take a look at the apparent dogs in the market and distinguish them from the real dogs. And of course, we're talking about stocks here. So how do you do that? How do you see a cheap stock and know that it's going to be one of value in the future?
I think there's a lot of art in it. And I think the art is staying within your circle of competence. So staying within what you think you can understand. So for instance, very high technology stocks, as a rule, I'll generally avoid them. I don't understand the technology behind it. I don't understand the market or the industry structure around those stocks. For instance, a retail stock, I think I can pretty much understand. You buy it for X and you sell it for X plus Y. So those are the kind of stocks that I stick to.
Okay, so it's pretty much understanding the companies behind, understanding how they make money.
Absolutely, you must understand the business model.
Mm-hmm.
Rory, just to talk about the reasons why you can find these stocks, and perhaps you can start talking about some of the companies that have made their way into the portfolio. The US market is massive, and there are an incredible amount of portfolio managers and analysts scouring the market for opportunities like this. Why do you think this inefficiency exists, certainly at this level, at the small cap level, where you can pick up stocks, when you mentioned, and we'll get into them now, that are just ridiculously cheap by any metric? Why do you think in such a developed market it's still possible to do that?
I think that there are a lot of large capital managers in the US. And so a stock that's got a 2 billion market cap is considered to be a mid cap. So if you've got a couple of billion under management, you find it very hard to fish around in a $300 million market cap or $150 million market cap. You can't buy enough of it to move the needle, even if it does double in price. So generally, as a rule, those stocks are ignored, and the analysts don't follow them because they don't get much returns from handing their analysis over to the large portfolio managers. So in general, I think that those stocks in the small cap area are ignored and just underanalyzed.
Okay, and then obviously the other thing that we were discussing is the horizon. And here in South Africa, we talk about many fund managers having a value bias, being long-term investors, so they say. In the States, is it the same? Is there a culture of value investing that's as big as it seems to be here in South Africa?
I think culture is probably too light a word. I'd say a cult. There's definitely, the Warren Buffett cult is well known worldwide. There's definitely a huge culture of value investors that look around. But what happens is the really good ones, they make a lot of money and their portfolios grow, and so they move out of that small cap area. And so the stocks are still there, and there's still the opportunity.
But do you stick, surely the area of value investing isn't specific just to small caps and mid caps. We know that many multinationals are going for ridiculous prices, many say right now. So is that also an area that you look at and you hold stocks in?
Absolutely. I will look at large cap stocks if I particularly can understand their business model and they're not too complex to analyze.
Yeah.
I will look at them.
But do you specialize in the small cap space?
Not particularly. I'm indiscriminate. I will happily buy value wherever I find it. It's just very unlikely to find it in the high cap stuff.
Because of their concentration of analysis. In terms of some of the companies that have made their way into the portfolio, let's talk about some of those just to get our viewers a feel for how cheap some of these companies are, even in the US. You mentioned, I think off air, was it a company called Body Contour?
Body Connection.
Body Connection, sorry. Tell us about Body Connection and why that was so cheap.
Body Connection is a favorite stock of mine. It's a highly focused niche retailer. The niche it occupies a woman, teenage woman up to mid-20s. Okay, so that's a highly focused niche. It has something like 240 stores. Okay, which is a small amount. It's got 162 million market cap. Firstly, let's just put that one up front. It's got an EBIT over tangible capital of about 60%. It's growing phenomenally. It's growing at 35 stores a year. Mm-hmm. Okay, it doesn't need any external capital to grow. It's growing out of its cash flow. It has no debt. It's got $44 million in cash sitting there. It can generate a new store for $145,000 a store. That's $105,000 to build out and $40,000 in stock. Mm-hmm. They expect out of every new store that they put up to have somewhere between $800,000 and $1 million of sales in the first year. It's an incredible stock. It's very cheap. What happened? It used to be trading at $30. They had a merchandising miss. They had stuff that nobody liked. It didn't sell. They had to cut their prices. The market collapsed down to $8.50.
But they've rectified that now. They're going to get the merchandising mix right now in the future.
In fact, one of the phenomenal things about the company in their most recent conference call, management stood up and said, everything we've done is self-inflicted. And as it was self-inflicted, we can fix it. And it's nice to see management taking responsibility for their actions.
Now, this is quite an interesting idea because Warren Buffett recently bought $10 billion of stock in IBM. And he said that he had no prior meeting with the management beforehand. He spoke to some of his IT staff around what systems and hardware they use from IBM, but he made a $10 billion investment purely on the basis of reading the financials of that company for the better part of 40 years. Is it necessary to go and meet with management, or is it an advantage or is it actually a disadvantage because you get sold a story? I don't know where you fit in there and how often you get the chance to actually go and meet with the management of some of these companies.
I actually don't go and meet with the management, but I will go to the store and watch people walk in and out of the store and look at the market. Is the market that they're targeting the people that are going into the store?
Is what they're selling you on the paper really happening in real life?
Exactly. And then go and talk to the manager of the store. How's things going? What's it like? They're happy to talk to you.
Tell us about some other gems where management, kind of has played a role.
I would say one where management played a role, but they made a serious foot fault, is there's a company called Career Education, which is a pay-for university. Okay, and they've got an incredible business model. I mean, they don't need cash to grow. They have students who come in and look for an education, and they specifically go for courses that are around cooking and chefs and chef qualifications and nurses and policemen and those kind of stuff. So really degrees that have some value, not a BA in basket weaving. And unfortunately, the previous CEO, and this was some time ago, had fudged the numbers somewhat because they get funding from the federal government on the rate of graduations that they get. And the numbers weren't quite as strict. And so the company completely collapsed. It's trading below working capital now, net working capital. It's cheap as chips. You can't get cheaper than that.
So then, of course, we got to look at, how do you, what are the rules that you have? Some of the rules that you have to distinguish. There again, how do you distinguish whether you're buying a cheap company because the market is just not in favor at the moment, sentiment's turned against it, made some mistakes, and there's opportunity in the future, or it's going to stay cheap and probably get cheaper?
Well, for the most part, it probably stays cheap and does get cheaper because as a value investor, when you find something which is particularly cheap, you've got to ask yourself the question, is it permanent or temporary? And if you can determine if it's permanent, then you want to avoid it, obviously. And mostly it's temporary. But it's been drawn to your attention that it has come down in prices and is well priced. So you're going to buy it. But that market sentiment isn't going away. And so it'll probably get cheaper. And that's something you deal with as a value investor.
I think at the core, though, when you get a stock that's so cheap, you can almost say if it goes out of business, you're still going to make money because you've bought it less than what its fire sale price would have been.
Well, exactly. I mean, a quick rule of thumb on liquidation is that if a company is trading cheaper than its net working capital, okay, when you liquidate it, you'll get more because you'll get at least net liquidation capital as a liquidation.
Just one other question here, Rory, and I see this looking at some of the holdings in the portfolio. There does seem to be a sectoral trend, if you could call it that. You've found some very cheap companies in the same industries, and I'm looking at Career Education Corp and Capella Education Company. Is that a function of something that's happening at the macro level that's made the sector very, very cheap, or is it just by coincidence that out of the 5,000 stocks you look at, 2 of them happen to be education companies?
No, it's actually something that happened at the macro level. Okay, in the macro level and the pay for education, there was a dust up with the federal government. Okay, and the dust up with the federal government was that the federal government was going to try and was talking about pulling the licenses of these companies because they were considered to be exploiting students. And out of that federal dust up, people sold those stocks off. And so, of all I think there are about 5 or 6 listed companies that do education. One of the ones is that supports the Washington Post. I mean, Kaplan's is a huge pay-for company. That's the cash flow that keeps the Washington, sorry, not the Washington, yes, it is the Washington Post, keeps the Washington Post alive. So these things are really good cash generators. So will the federal government pull their licenses? Well, I fancy the Washington Post lobbying capabilities.